Welcome to the Education of a Financial Planner, where we look at the major concepts in financial planning through the lens of two quant investors who are learning the ropes of the planning process and how to help clients achieve their long-term goals. Learn along with us as experienced financial planner Matt Ziegler helps us understand the most important financial planning concepts that impact all of us and how we can apply them to achieve the best outcomes in our financial lives. In each episode, we will work through one major financial planning concept from the ground up and learn how we can apply it in the real world. From retirement to college savings to taxes to estate planning, we will cover a wide range of topics that apply to each of our everyday lives. We hope you will join us in our learning journey.
Justin Carbonneau and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
Welcome to the Education of a Financial Planner. Jack, we're going to talk about one of our favorite concepts, the long death of this thing called value investing, why we both still believe in it, and what it means to both of our practices. Because like this core ideology from Buffett to everything all at the margins of what value investing means, like this has probably shaped my career. Has it shaped yours too?
Yeah, definitely. It's been, and I've seen all sides of it. I saw like when we started doing this like in 2003, we saw some great performance from value from a long time. And then we've seen, that other side of the coin that exists, but you don't really realize it until you see it. Like we've seen that for a very, very long time. And, it seems like to your point about the long struggles of value investing, every time it seems like we've turned the corner, 2020 or whatever, there's been a bunch of times like that. It's like, all right, we finally turned the corner. Then we get right back to where we are this year. Where it struggles again. So I think it's a timely discussion for us to be having.
It's a very timely discussion for us to be having. So I'm going to break this up a little bit, but I actually want to start here because you wrote about it. You've got some pieces up on this on the Validia blog. Will you just give us Michael Maubousin's value definition? Because I think I want to say that first, and then let's get into the shades of gray.
Yeah, well, this is where I fall into a trap as a quant investor, because as quant investors, we always think of value in a certain way. And we think of it as like we rank all the stocks, and those stocks that are statistically the cheapest, we think of that as value investing. And we don't think of other things as value investing. But when we had Michael on the podcast, he corrected us. And what he said is, I remember exactly how he said it. He was like, value investing is buying something for less than it's worth, full stop. And that's right in the end. Like it doesn't just because quants define value in a certain way doesn't mean value can't be defined in a very broad way. I mean, ultimately, we're trying to buy something for less than it's worth. And if you end up being correct about that, you've made a value investment, even if it wasn't cheap on statistical metrics.
And that's the challenge, right? Like we want to feel pure ego. We want to feel smarter than somebody else. We want to feel smarter than the market, whatever it is. We want to say like, I saw this thing's value today that got realized later. And therefore, oh, what a good boy am I, right?
Yeah, no, absolutely. And unfortunately, those of us that are using statistical value have not seen that. We bought this thing cheap, but it ended up being cheap for a reason. But yeah, no, and I think that's right. And, when we talk about like the article you referenced, I was talking about this idea of is value investing dead, and we'll talk about some of that. But if you use Maubousin's definition, value investing can never be dead, because ultimately there's always things you can buy that you're buying them for less than they're going to end up being worth. So if you use Maubousin's definition, value investing could never be dead. If you use the definition of quants like me, it may or may not be. And then that's something we'll probably talk about.
I will definitely talk about it. And let me just offer a scientific amen to you, brother. Let's dive in here, because I think we both define this, and I'm going to let you define this piece of it first. And then I want to give you the way that I explain it with clients and at work all the time. Distinguish for a second, because beyond the Mauboussin definition, you've got Graham, Buffett, and Bill Miller, as like three different quote unquote value investors who have a totally different approach, really interesting to systematically and quantitatively break down what they're doing and how they define value. But be the quant for a second here, and then I'll try to be the poet. Tell us the difference between Buffett and or Graham, then Buffett, then Miller, and maybe the evolution of those three value styles.
Yeah, when I'm trying to explain it at a high level, that's the way I always explain it. Because if you go back to what I was saying about the way those of us that are quants look at value, that's really Graham value. We're buying companies that have major problems. We're buying them at a significant discount. Now, if you take, and Buffett used to be that way. He's not anymore. But if you go to like what we consider Buffett value today, you know, Buffett has decided I want to buy good companies and I want to try to buy them at a discount. So I'm buying much better companies than like a Graham type approach. And those of us that quants would explain that as sliding up the quality spectrum. So I'm adding quality to my value strategy. And then, you know, Bill Miller bought a lot of companies that by no statistical measure look cheap, but he was looking at, you know, what is the potential growth of these companies? What is the discounted present value of what they can do in the future? And he ended up being right about a lot of those things. So I consider that Bill Miller value. You know, that allows me to buy companies that are even more expensive, but I'm buying them at a discount to what I think their future potential is.
Thank the non-scientific gods for Bill Miller and all the lessons he's bestowed upon us over the decades of our investing careers here. And challenging the view. I really, really appreciate people like him and Mauboussin who make you challenge like the math that looks so obvious as an easy way to be smart. So the way that I always try to explain this is I like to differentiate between melting ice cubes, finding glaciers, and forming glaciers. And this is the idea. You're familiar with the melting ice cubes explanation, which I think I probably learned from Greenblatt originally. Do you know the melting ice cube thing? No,
Yeah.
You put an ice cube on a table and you're just watching it dissipate. And I remember Greenblatt or somebody explaining this years and years ago where they're like, if you're value investing in a melting ice cube, you got a couple of options. In the true Graham sense, there's like the liquidation value of the thing. Like, is the ice cube worth the water that's in it, basically? Nets, cigar butts, buying something where like there's more cash in the bank than the shares are worth. And if I just liquidate the company and kill it today, rip the Band-Aid off, it's more to me as a takeover. That idea of like buying businesses that are effectively dead men walking and you should just put them out of your misery, that's really useful to know. Because on a pure accounting identity basis, you can just take the thing out. Because if you put that ice cube on the table, eventually it's just going to be a puddle. Whereas if I take the ice cube and I put it in a drink, at least I get some friggin' purpose out of it. And that's one form of value investing, how to approach a melting ice cube. The second form, which I would say is more like how Buffett evolved, is this finding glaciers approach. And glaciers, you have kids, you've dealt with science class a little bit. Do you remember like with a glacier, both how it's formed? This is going to hint into the next style. Do you know where glaciers come from, Jack?
I don't actually. So you might be able to inform me about this.
Well, as someone who has not shoveled sidewalks too diligently at more than one point in my life, first you get the bed of snow. And then if you don't remove it and a few days go by, the snow starts to like melt just a little bit with the seasons or with like you get an unseasonably warm day. And then you get a little more snow and the snow compacts and turns into an impenetrable sheet of ice. And effectively, this is where glaciers come from. Precipitation comes down from the sky, it sits on the top of the ice, and then if it never melts enough and goes back into the, stream, lake, whatever, ocean, it just turns into a harder and harder, denser rock of ice, and it just keeps growing over time. And one thing Buffett realized, I think, is this whole idea of like finding glaciers. I want to find the companies where this quality factor, this thing that's around them, allows for them to just keep acquiring mass over time, grow and grow and grow and grow. And that's kind of an obvious thing to look for when you think about it. Looking for quality is basically finding glaciers. Find the big thing that's really hard to kill. That's what a moat is in its simplest form. Now, the third category, and I asked about finding glaciers, or because I wanted to talk about forming glaciers too, this is Bill Miller in my book. When we say we're trying to look at forming glaciers, he was looking at things like Amazon, for example. And he said, what's the total addressable market of this space? Where can this thing grow to in the future? And that's to say, I got a snowflake, or I got a snowball, or I got whatever today, and how is that going to grow over time? It takes a creative look at the future. It also takes a crazy understanding of that macro environment, or the thing that allows this market to develop. Because the brilliant part about when you're looking for forming glaciers is you're looking at things that are going to grow that moat that Buffett sees and is interested in capturing much, much later in the process. A lot of us think of that as traditional growth investing. People like Bill Miller taught us there's ways to try to think about this from what they could grow to become and how they become the next glacier over time. So that's my poetic version of value investing.
That's good.
Melting ice cubes, finding glaciers, and forming glaciers. quantitatively assess that for me. Does that make sense?
I like that. And that's also, now I can understand why when I try to shovel my driveway 3 days after it snows, it's always a catastrophe.
It's a losing battle.
You're finding glaciers has made me understand that I need to get out there right away now before the glacier forms in my entire driveway.
Okay, so now that we've kind of covered that, let's get into like the struggles of value. I'll keep relating it back to glaciers, I'm sure, but the struggles of value itself, like.
Yeah, so I mean, we just have to put it now. If when we say the struggles of value, we're going to the definition, like the Graham quantitative definition, cheap value, and it struggled for a really, really long time. I mean, it really goes back to kind of '07. You've certainly had periods where it's done well in there, but going back to '07, I mean, you've got pretty good, underperformance for value, relative to history and also relative to the market, and so that's what a lot of people, you see all these articles all the time now, like, is value investing dead? Does it work anymore? And like that's what people are trying to wrap their arms around, is this idea of buying statistically cheap companies hasn't worked for a very, very long time. And the challenge is, with any strategy, when you have a strategy that hasn't worked for a really, really long time, but does work when you expand it to a much longer time, like 100 years or something like that, how do I know when to switch? How do I know when this strategy doesn't work anymore? And it's a really, really tough question to answer. You have to try to use the facts as best you can. And that's this article you referenced. That's what I did. But it's a really big challenge. And I don't know did you read that article Corey Hofstein wrote? It was called Factor Fimbulwinter.
I've read that one.
So the idea was, this is a long time back. So the idea is he tried to use like statistical methods to say, and he was using the price to book. And he was saying, like, just from a pure statistical standpoint, given how much long-term data we have on value investing, how long of a period do I need of it not working for me to be able to say it doesn't work anymore? And, what he found in that paper, using some of these statistical methods, is that period is longer than most investors' lifetime that they'll be investing. And so we're not going to be able to say conclusively with data, value investing is dead. So we are going to have to do what people like me, like quants like me, hate doing, which is, we're not going to use a quantitative process here. We're going to have to actually look at, what's going on. We're going to have to analyze it, and we're going to have to make that decision on our own.
So I got to ask you a question, because back to like my melting ice cubes analogy, and I really wonder this. So this is a genuine question, and I don't have the answer to it. So I don't expect you to have the answer either, but I just want to ask it. It kind of strikes me that in the melting ice cube perspective, like, it's hard to be a public market melting ice cube traditional value investor for the last 10, if not 20 years, outside of that brief period in right after the dropping out of the bottom in the tech bubble. Is that because like the best investors in that style have kind of been like private equity? Is this like the long extension of like LBOs and stuff like that? If you're truly investing in stuff on the verge of liquidation, is that why it kind of left public markets, but it shows up in the private equity side of private markets, you think?
It could be. First of all, when you were talking about melting ice cubes, I was thinking about, like, you should never name your value strategy the melting ice cube strategy, because your analogy
tips.
Your analogy works, but it would not work from a marketing perspective. Come invest in my melting ice cubes fund. But yeah, no, I mean, that could be part of it. It's hard. As more people are involved in the market, it's a question I ask myself all the time. Like, are these opportunities truly opportunities anymore? Is it, you have so many people analyzing these companies and analyzing the problems.
It's an arbitrage thing, right? Like, who's going to close the window? Who's going to close this gap?
Yeah, exactly. And, our company, and it gets through so many other things. Like, I don't know if you remember David Einhorn's appearance on Patrick O'Shaughnessy's podcast, where he kind of talked about this. And he was kind of saying, because part of, when you're a value investor, part of what you're investing for is multiple expansion. You're betting that the market is going to, you're betting hopefully the company is going to turn around too, but you're also betting that this company trades at a discount to what it should. So the market's going to pay more for those earnings eventually. And like David Einhorn was kind of saying in Patrick O'Shaughnessy's podcast, like, I'm giving up on that. Like, I'm using I want to make money in other ways with my value strategy, but I'm giving up on this idea that like the market's going to eventually see things my way and is going to revalue these companies. And so it's a challenge. It's obviously, companies are cheap for a reason. I mean, we're not going to find the next Google trading at 5 times earnings. Like, within reason, that they're cheap for a reason, but we're just sort of, as value investors, we're betting statistically the market is getting it slightly wrong on a basket of these across a wide variety of them. And, usually that's worked out pretty well. Usually it's overestimated the problems of these companies, but it's been more of a challenge definitely in recent years. It hasn't been working as much.
What do you think within the struggles of value and it not working so much? Like, how do you actually frame, I guess, like, think about it like just behaviorally too. So there's changing market dynamics that might dictate why it's hard to close that gap. But like, what's going on? What do you think's going on behaviorally within the investor base? Like when people like Einhorn defect from the value camp, value religion, like what does that mean? And is that part of why it's sucks so much?
It's funny. We talked to Tobias Carlisle when he came on the podcast about this, and like he sees that, I probably would agree with him. He sees that as an opportunity. Like he wants like guys that would be considered like your traditional, value guys that have been stuck. You want those guys to abandon it to some degree. Because if you think about it, like think about it at a high level. Like if I have these companies that are cheap, and let's say like tons of people become value investors, and this is one of the things we were going to talk about later, but let's say tons of people become value investors and they start buying these statistically cheap companies. What's going to happen to the gap between those statistically cheap companies and the growth companies, the expensive companies? It's going to narrow, right? And so now my opportunity set, I've got a good return as a value investor while they did that, but now my future opportunity set, my expected return is worse because now my gap here is less. Now I can get the growth companies for cheaper relative to the value companies. And so I think that's like an interesting way so to some degree, when everybody's abandoning value investing, it's good. It's terrible for my current returns, but it's good for my expected future returns. But the other side of that is obviously when that goes on for decades, you have to ask questions beyond that because, when those of us that are value investors, when we look at what I was talking about before, which is just how expensive are expensive companies relative to cheap companies, we've got historically wide spreads right now. So we're not seeing this idea of like tons of people buying value companies because the spreads are historically wide. But the question we have to all wrestle with is they're not closing. And, we've seen long periods in history besides this period where they didn't close for a long period and then they close really rapidly in 2-3 years. The question we're wrestling with is, are we going to see that again here? And, those of us that are believers in it think, yes, we will at some point, although we don't know there's no way to predict when that might happen.
I always think of, and I'm pretty sure I'm jacking this straight from Wes Gray, I always think of this idea that value, because value and momentum get kind of like defined behaviorally by the same cognitive errors, if we want to explain it behaviorally, where value is the overreaction to bad news and momentum, or the inverse is that, is the underreaction of good news. So the overreaction to bad news followed by the underreaction to good news in events, markets, prices, whatever you want to call it, like creates this weird gap. And I think the shades of that gap too, of who's going to close them, like who's going to close the gap between really terrible and modestly bad. And then who's going to close the gap between like bad and not so bad, and then not so bad and okay, and then okay, and that's good, and that's good, and that's great, and that's great, and that's amazing. And each of those represent a group of investors who are just trying or hoping or figuring out ways to close that gap through various mechanisms. And I kind of wonder, it's just like it's not that there's a shorter list of people to close that gaps. It almost feels like there's a shortage of stories to help close that gaps, because I think of like the Toys R Us and private equity route again, where it's just like, well, here's a more or less dying business model. And it's either like somebody's going to take it to private equity and maybe eventually to liquidation, or like public markets are never going to figure it out. I think of GameStop the same way. Like GameStop deserved to die. Like it was a dying business model. It was the ultimate melting ice cube, but the only thing to close that gap is story. Do you reconcile that in any way, or think of?
Well, this gets it. We do a separate podcast with Ben Hunt, and this gets at a lot of what he's talked about. But so this whole idea, have you heard him talk about the weighing machine Graham quote?
Yes.
Well, first of all, that's not a Graham quote, so we should probably, apparently that's something Buffett said, the Graham might have said, like, whatever, it's not. Justin always points that out to me, whatever. Whatever. But I'm going to pretend it's a Graham quote for the purpose of our discussion. But, sure. Ben always talks about this idea that, the quote is the market's a voting machine in the short term and a weighing machine in the long term. And, Ben talks about this idea about how it really is a voting machine all the time. And that's very true. And, the way I look at it to kind of bridge the two is it's a voting machine, but it's a voting machine you would expect to vote over a long period of time. You would expect to vote based on the fundamentals of companies, because ultimately at some point, if I'm investing in a share of a company, you'd have to think the market would care what's going on in that business. But that kind of gets at this whole thing of, we need people, value investors need people to vote for value. They need people to vote based on fundamentals. And in order for this to correct, someone's going to have to buy these companies. And that's the hard part about this, is like narrative has been driving the market for a very, very long time. That's something I've learned a lot, from Ben on. And we need sort of that narrative to change. And, Ben, by the way, would tell you at some point this can change, but he'll tell you it's not going to be a change based on fundamentals. It's going to be a change based on the story, like you said, of value becoming the story people tell. And, maybe that is to some degree, although it hasn't happened as much as I would think, you would think something like inflation would drive that story of value, that story of, well, I need cash flows from companies now. And it did for a little bit, but it hasn't, and maybe part of that is inflation's coming back down. It hasn't, but I think that is a true statement. I think, ultimately people are buying and selling every day, and that's determining what's going up and down. So you need people to vote for these types of companies for these spreads to correct. And you would hope that they're eventually going to vote based on fundamentals, and that's what's going to lead it to happen.
I think there's so many awesome examples of this, and we used it in another. I want to connect this to two things. We did another episode where we talked about the my AAA framework, as I like to call it, of things that go from awful to average to awesome, and like the stopping points among each, and how really narrative steers you from like, how does awful just turn into average, and the shades along the way. Really useful. Inside of this too, like with financial planning, we work with a lot of business owners, and with business owners, just talking through this logic of like in the last decade, I've helped multiple people actually like shut down businesses when they were melting ice cubes. And it's like, if you can't figure out as the owner what the story is, that's going to take this awful business back up to average, let alone like forget amazing, just get back up to average. If you can't figure out what the story is from your competitors, from your suppliers, from your customers, how we're going to turn this thing there, then you sometimes have to admit when liquidation is the best bet. What is this thing worth? Likewise, working with some founders where like they're on the explosive growth curve, and it's like, well, maybe things are amazing right now, but are they going to stay there? Are we in this true Bill Miller paradigm of where you're forming a new glacier? Or is it like, we're going to hit this up to a certain point, but then extra Mauboussin, like the moat sets in, the return on equity sets in, starts to stabilize, reverts towards average. The narrative then shifts, and we have to understand how we're moving back from amazing back down to average. And are we okay with that? Because is that the business that we want to create? I wanted to say that because it's like, these concepts are so much bigger. They affect the companies we build, we make. They affect the companies we work for. And like understanding this framework is a really big deal to just seeing the environment that we're in and how these stories are working for us or against us.
Yeah. And it's interesting. Like we don't have, that idea of stories, like in our value space, like we don't have that many great storytellers. Like I remember going back to Ben Hunt again, like he was talking about Mark Benioff and Elon Musk's a great example of this too. Like in the growth space, you've got these guys who are really, really good at telling the story. Elon Musk, you could argue Tesla would not exist today if not for, during that whole time where there was the funding secured 420 tweet, like back, the company was on the verge of failing. But he was able to tell the story. He was able to keep the stock price up, and probably the business exists today because of that. And, on the point of Benioff, like a lot of these guys will come up with, the growth guys are really good about taking your standard financial statements and starting to adjust them with these metrics and then telling the story about that metric. Like you get to a point where it's almost like, earnings before expenses, which is effectively the same thing as revenue, is a number that they would report, but they would call it earnings before expenses to make it sound like it's earnings. So like it's interesting, but like on the value side, we're not very good at that. Like we don't have these, charismatic guys out here telling the story about their steel company. It's not working in our favor.
Well, and it's just the reality of it, right? Like you can't look back and study earnings before expenses or whatever that crazy.
Right.
I'm trying to remember whatever the WeWork one was. Do you remember what the WeWork?
Yeah, I forget what it was, but it was crazy. Yeah, it was basically like it told you nothing at all about the business.
It's right. So narrative can exist in that gap where there's something you can't empirically study. And that's a really important thing to understand, a really important thing to be aware of. And I kind of see it as like, that's another variation on, and maybe talk about this, because when you have the hard data, how do you think or rationalize through like the risk-based explanation for value? So the mathematical risk side of it versus the actual like human psychological behavioral side. frame those justifications, and then we can map it back to.
Yeah, this is really important because, if you ask people normally, like your average person, why does value investing work? There's like, well, the same thing if I go to a store, I'm buying something cheap. Like if I buy something cheap, that's a great investment. But the reality is, we have a pretty efficient market. So ultimately, most things that are cheap are in the cheap range for a reason. Most things that are expensive are in the expensive range for a reason. So we kind of go to academic research to figure out like, why does this actually work? When obviously these companies have some issues or they wouldn't be cheap. So we have two explanations. One is the risk-based explanation, which is to make it really simple. Like if you invest in something that's riskier and that's a risk that gets compensated for, I should get a better return. I should get a better return for taking on that risk. So most people believe that's part of the explanation as to why value investing works. The other one is what you referenced before, which is people overestimate the problems with value companies. And if you buy a basket of them and hold them for a period of time, you can benefit from the fact that when we realize we've overestimated the problems, they're going to do a little bit better than expected. Again, this doesn't work on any individual company level, and this gets to the idea of value traps and stuff. There's some companies in that basket where it's actually worse than the market thinks, but across a wide variety of them, typically, things have been a little bit better than the market thinks, and you get a little bit of a return. So when we look at the academic research, that's probably I'm trying to simplify it as much as possible, but those are the two reasons they explain as to why value investing works.
I think that's a perfect explanation. And it's back to what we said at the top. If people are overreacting to bad news, you're willing to take the other side of that trade. You're betting on the overreaction, then you are shouldering more risk while they're overreacting. Like, I don't want to liken it to like running into a movie theater with the fire alarm going off to pick up candy bars, but it's kind of like that's the modern or more modern Ben Graham cigar butt here. That cigar butt that still has one puff left in it. You're benefiting from the overreaction of the other, but you're taking more risk to do so, and you just better get compensated for it, which the market can be an unforgiving beast when the stories run amok.
Yeah, and and it's important to think about like what taking that risk actually looks like. And this is why like we run value strategies. For the right investor, I think value investing is great. For the average investor, I think it's not. And because that's the point, is like it's not going to be like, it would be great if it's like, all right, the market's overreacting. Let's buy the stock tomorrow and they're going to stop overreacting. That's going to be fantastic. And I'm going to get all these returns. And like, that's not the way it works. Like you're going to sit there and suffer for really long periods of time if you run a strategy like value. That's just the way it is. And we're seeing it obviously now for like a decade plus. There's going to be these really, really long periods where it just doesn't work. And that's, we can look at risk and we can volatility and like all that stuff people like me look at, but that's what risk really is. Risk is sitting there and looking at your portfolio while it underperforms over and over and over again and being able to not abandon the strategy. Because in a 2-year period, at some point, you're going to get such ridiculous returns that it's going to make up for that. Like that's the history. I'm not saying that's what's going to happen now, but that's the history of value. The history of value is sitting through, the late 90s while you're just underperforming for outrageous periods of time. And then from 2000 to 2002, while the market goes down, you go up a lot. Like that's basically what it is. But like sitting there, like if you think about, like, I don't know if you were investing in 1999, but it was like anything.com is up 300%. And like these stocks weren't going up at all. Like you were just getting smoked. Your neighbor was all excited, your neighbor's Lamborghini or whatever's out there because he bought these crazy, it's a very, very hard thing to do behaviorally. It's just a huge challenge.
I love this too, because, so I was still in high school in 1999. I was going to college. But I remember people talking about like the market and talking about this stuff. And I'm pretty sure I even remember some friends getting involved in stuff. And I remember being so ignorant to what was going on, aside from like little things in the paper. And like, I will regularly have moments after, almost 2 decades in this career where now I look back and I start to think to myself like, oh, that's what they're talking about. It's kind of like, you remember the movie Honey, I Shrunk the Kids?
Yeah. I haven't seen it in a long time, but I do remember it.
The classic quote from that movie is, oh, French class. Now I get it. Do you remember that bit from the ending?
I don't think
credits. So there's a scene where like the main hunky teenager guy character is kissing. Well, he is giving mouth-to-mouth resuscitation to the female lead character. And when his younger brother asks him how he learned to save her life with CPR, he just turns and says, French class. And of course, the kid doesn't get it until in the closing credits. Like it's like the classic zoom out, and then he like pulls the thing back and he goes, "Oh, now I get it, French class." I am the person who doesn't get it till the closing credits. That's the lesson here. All right, so sorry for that tangent. Take me back to, I want to talk about regimes, because in the planning to get punched in the face, self-flagellation that you put yourself through as a value investor, when we and I'm on the record, I think like regimes are really important and less important in the, like we have like the narrative labels, which are really important to define them. But I think it's also like when we talk about regimes, we're always talking about this, like, is it stable sloping up or stable sloping down? Or I like to think of it as, is that swinging, stable and swinging up, or stable and swinging down, or volatile and swinging up versus swinging down? Case in point, like when we talk about like the Fed, when we talk about inflation, we can say 5 years ago, we were in a like stable sloping down or just kind of flat going nowhere environment. But the last year, 2 years, it's been crazy swinging up and now back down in some cases, depending on which factor, which narrative you're tracking. So let's tackle regimes a bit. I want to hear how you think about them. I want to try to wrap back in the way I try to think about them and for clients and stuff. Let's talk about the Fed. The Fed just changed the game. Is this the death of value investing? Now that short-term rates are swinging up, and I don't even want to get into what long-term rates are doing. Did the Fed kill value investing? Is there an argument there?
Well, this gets into, you and I just recorded a podcast with a great researcher from Georgia State who's going to, has looked at this stuff. So this gets into all the things that those of us that are value investors can blame. So we love to blame the Fed. It's one of our favorite things because, and then think about it in theory. In theory, it makes sense. So it's like, all right, rates were abnormally low for a very long period of time. Let's look at a growth company and a value company. Where is the value of a growth company? Much more of it is in the future than in the present. Much more of the value of a value company is in the present. So you would think when rates are high and I've got more value in the present, like rates being high would be great for value strategies and rates would be being low would be great for growth strategies. So we can go and we can blame the Fed and we could say if they just hadn't manipulated the markets and kept these rates very low, we wouldn't be underperforming. The problem is that doesn't hold up in the data, and it doesn't hold up for a couple of reasons. First of all, if you look at value and its performance relative to interest rates, the data is really inconclusive. It doesn't show that in these high interest rates periods, value beats growth, and in the low interest rate periods, growth beats value. Although it did in the most recent one, it doesn't show that way. When you look at inflation, the data is a little bit better. Like you can show a little bit that in high inflationary periods, value does better. But again, this gets it. This is the challenge. You can't really blame the Fed, and you also can't say for sure, now that rates are high, using that same argument, now I need to invest in value. So it's one of those arguments you see a lot of the times, but when I look at this argument, it's not really that strong of one. There's not a lot of data to suggest that, high inflation and high rates, it's time for, the huge run of value. It might come, but it's probably not going to come because of like the economic environment or the regime we're in.
I think my beef with the regime term is when people confuse it for single variable analysis. Because of all the things you just said. I think if you're only focused on like Fed activity through the lens of being a single variable, you're kidding yourself. You're thinking you can tell the whole story with one variable. Like it's never as simple as that. And the Fed, I think, is a prime example.
And the hard part too is like, all right, we may know what regime we're in, but what regime are we heading into? Like, look at us today. Like we're in a higher inflation regime right now. That's true. Inflation's coming down to some extent. You've got people who believe we're going back to not to 0%, I don't think anymore, but like to a lower inflation, lower rate regime. That's where we're going to head here. We're going to get a recession. We're going to head back to that. And then you've got other people who think, we're going to be looking at a decade here of higher rates. So a lot of it is, it comes back to expectations in the market. I mean, the market's pricing in expectations. So it's hard to even figure out like what regime we're going to be in the future. Not just, just because we're in it now doesn't mean we're going to be in it 3 years from now.
And I would say, and this applies to if you're public markets investing, if you're private markets investing, if you're thinking about the business that you have or operate, or you're thinking about the company you work for, like in an environment where inflation might be coming back down, where rates might start to like top out or trend lower at some point, you could think about, is this a melting ice cube? Is this a glacier that's sustaining and growing? Is this a glacier that's starting to shrink a little bit? Or is this a glacier that's just forming? Because in any regime, you can have like all three or more of those scenarios exist if you look around, which is, I think, a really useful exercise to think through.
And I think for, I talked about before why a lot of people shouldn't be value investors, but for people who should, I think a lot of them should be the glacier type value investors. And that's not because, you've probably seen Tobias Carlyle looked at Greenblatt's magic formula and broke it in half and said, you've got your quality part and you've got your value part. And he said, yeah, value on its own, if you break it in half, get rid of the quality part, the value part actually outperforms the magic formula altogether. But the ride with the quality part added in is much, much smoother. And so, if you think about it behaviorally, all I care about as an investor is the returns I actually realize in the real world. Like, I don't care about some back test or some whatever. So and to realize those returns in the real world, I have to be able to stick with my strategy. So I think that glacier type approach for most people, you're getting better businesses. Like to your point, like if we go to a recession or whatever, those businesses are going to do better. You're probably going to have a much smoother ride. Like for me, I think a lot of value investors, normal people who are practicing value investing should probably be in that camp.
So then under that description too, like is value or does value not work because there's too many people doing it, Jack? It's so cool. All the kids are here already.
Yeah, and that gets back to what we talked about before. So that's probably one of the weaker arguments for value, at least right now, because again, going back to what we said before, if too many people are doing it, what's going to happen? The spreads between people are going to buy value stocks. The spreads are going to narrow. And then you could argue now my expected returns on value are lower, but the spreads right now are as wide as they've ever been. So it's very hard to argue you've got too many people buying value stocks. The problem right now is I don't think anybody, me and a couple other people, Tobias Carl and a couple other people are buying value stocks, but a lot of other people are not. So I think that's one of the weaker arguments against value, at least right now.
I can very much appreciate that. The value swings back and forth between being like the cool kids, between captain of the football team or whatever, and being like the goth kid in the back of the room. Right now, value is definitely the goth kid.
And it works, by the way, it works both ways too. There were periods like this is one of the things I got wrong in my career. Like if you look at 2014, 2015, the opposite of this was true. Spreads were really narrow. Like value was very expensive relative to growth. So that argued that, growth was actually cheap. And by the way, that's the way it played out in the real world too. That period was a very bad period for value. So it can work both ways. It can be narrow, it can be wide, but in either case, it's not going to correct itself like right away. It's going to probably hold for a very long period of time. But it is, one of the mistakes a lot of value guys like me make is we kind of always want to be value investors. And, that's probably good. You probably want to continue to run a strategy over the long term, but we fail to recognize that there are periods also where value is not cheap. Although I can't remember them because it's been so long, but in theory, there are periods where value actually is expensive relative to growth.
Yeah, absolutely. Now, what about this idea that like big data has arbed this all away? So A, did that happen? And like B, I think it's worth you mentioning a bit about like the value spread, if you will, or just the way it's arbed.
Yeah, well, this is one I wonder about. I don't know the answer to this. I wonder about so we're using financial statements. Most traditional value investors are using publicly reported data on financial statements. You do worry about so let's say I'm buying Walmart as a value stock. I don't know if it is or not, but I'm just throwing that out there. And let's say there's also, hedge funds who have got satellite photos of Walmart's parking lot and they've got it across the country and they're realizing, that there's way less cars in the parking lot than there used to be, or people have real-time credit card data from all the credit card companies and they're realizing people are spending less money at Walmart. Does that give me a disadvantage, using reported fundamentals to buy these value stocks when there maybe is more real-time data available about these businesses than there was before? And so you've got these hedge funds, selling Walmart as we come into the earnings report because they know something's wrong, whereas the traditional value metrics will tell you it's a cheap stock. I wonder about it. I mean, I don't really have a great answer about it, but it's something I think about.
You're making me consider the idea of a bucket shop versus a shop to buy buckets at, and I feel deeply profound. What about as a bet against technology? This is in all these examples you went through in this article, which I'm sure we'll link to in the notes here. But talk about and I actually kind of hate this one. Value, and so does Bill Miller. Is value a bet against technology? Do you hate humanity in our
I do. We don't want progress, basically. We just want value investors want us to stay in the world of steel and coal. And, we love that kind of stuff. But no, there's a couple things here. First of all, it's how you measure it, which is interesting. So we've had Kai Wu on our podcast. One of the things people will say, and I think there's a strong point to this, is that we aren't valuing these technology companies properly. There's a lot of the value, if you think about it, in price to book's the extreme example of this. But if you look at Microsoft's price to book, who cares? Microsoft has some office buildings and some servers and suddenly the market value of Microsoft relative to that stuff, I'm going to care about that. No, that doesn't make any sense. So there's a strong argument we should be adjusting, and if a company like Microsoft is investing in something like R&D, something like marketing, they're creating an intangible asset. So instead of expensing all of that right away, we should create an asset. We should put it on their balance sheet. We should expense it over time. That's a better way to value these companies. So first of all, I think that is a fair argument. And I think those of us that, and a lot of us are these days, those of us that practice value should be probably making some sort of adjustments in our strategy to account for the fact that the economy is different and technology companies need to be valued differently than other companies.
Can I point out the irony of, do you do any of these calculations in Microsoft Excel?
I don't do a lot. I've read a lot of code, but that is true though. You think about it, like, yeah, value investors were incorrectly valuing Microsoft inside of a Microsoft product. So you could argue Microsoft has contributed to this, the misvaluation of Microsoft with its own technology.
One could argue.
But yeah, the second thing is, this idea that value strategies underweight tech, which is sort of true. So there's two different ways to practice value investing. You've got one way, which is, I'm just going to buy the cheapest companies. I don't really care how the sector breakdown works. I'm just going to buy them. And then the second is, which is probably a better way in many cases, is the way AQR and places like that do it, which is I'm going to do it inside of sectors. So I'm going to keep my technology weight pretty similar to what the market's technology weight is, but I'm going to buy the cheapest companies within technology. And so the first method is prone to this idea that, it is a bet against technology because the technology companies have traditionally been a little bit more expensive. So, historically that has been a bet against technology. And even the second one is to a degree, because if you think about it, like the companies that are truly providing the growth inside of the technology sector, like, am I really buying, even though I'm weighting it the same, am I really buying those companies? So, I think that is true that, like, to some extent value has been a bet against technology, but I'll also tell you, I think it's changing. So like Justin Carbonneau, my partner in our partner in this podcast is usually on with us, like just wrote an article about this. Like if we use, with Validia, we run all these fundamental strategies, and he took the Mag 7 or whatever and ran them through our fundamental strategies. And, the conclusions were wide ranging. The conclusions ranged from Tesla, absolute catastrophe, NVIDIA, very, very expensive. But a lot of these other ones, Meta, Microsoft, Apple, like these are fundamentally sound companies, and you're seeing them in value indexes now. So like you could argue this bet against technology is changing as technology companies become more part of the regular economy, as they become the more solid businesses that don't trade on growth multiples, they trade on value multiples. It's changing a little bit. We're seeing a lot more technology in our portfolios. So although it historically has been true, it's not as true now as it once was. But maybe with AI and stuff, well, obviously if those companies if companies come out of nowhere and become huge companies out of AI, like we won't be buying them for a very long time.
Goes back to this idea, like spotting where the glacier is prone to forming versus spotting a formed glacier. Like that rate of change is different, back to the regime point again. And then also there's nothing that doesn't say a glacier can't form over time and then sustain. And that certainly feels like where a number of those tech companies you just rattled off. It's like they've achieved glacier status now. It's really hard to not use Microsoft Excel in a spreadsheet. And what's your other option? Google Sheets? Like, come on. This is craziness. What about another one of my favorite arguments, because it always makes me think of the Nassim Taleb California forest fire story. Did the economic cycle just get so smooth that it doesn't matter anymore?
Well, let's talk about why that matters. So it matters because, and we maybe can put this in the video, but Aaron Stanhope from O'Shaughnessy did a thing on this. And so if you look at values performance across various stages of the economic cycle, a lot of the outperformance comes like in and around recessions. And so the idea is if a lot of the outperformance comes in and around recessions and you stop getting as many recessions, you could argue that that's a case against value. That ultimately, if I'm not getting, these recessions and value outperforms in the recessions, it's problematic. So again, I don't really know on this one. I mean, I'm not a huge believer in this. I don't really know if the economic cycle has smoothed out, although you do think, the Fed's better than they used to be. The government, we've learned about how to handle, we're going to handle current economic cycles better than we handled the Great Depression, going way, way back. So it is true. I think that we're having, we've had less and shallower recessions, but we did have things like 2008 as well. So I don't really take, I kind of get back to like analyzing companies as a value investor. I don't love a lot of this stuff about like, well, the economic cycle has changed, so value doesn't work. But it is absolutely true that, if you look at data, the recessions are less frequent and shallower than they used to be. And, you could argue that's a case against value because value does really well around those periods.
Point taken. So I'm feeling like my conclusion from all this is the gods are dead, but long live the gods. Where are you coming down on this? Like, is value dead? Is value still useful? Does it still have a place, not just in our hearts, but in our portfolios?
Yeah. So I tend to like ask a couple of questions when we see something like this. First of all, am I seeing something that is different than what I've seen historically? So is like this 10+ year underperformance of value, is it something I've never seen before in history? Because that doesn't mean value is dead, but it means I probably have to look at it a little differently. And the answer is no. I mean, this has been part of value investing for a really, really long time. And another thing which we didn't point out, which we should point out, is depending on which metrics you use to define value, the ride you're experiencing has been very, very different. So like when I talked about 2007, like the underperformance of value, I mean, that was really like price to book kind of started around then. And you sort of worked your way up the metrics, and you got to like EV to EBITDA, like years later, that started underperforming. So you've underperformed no matter what you've done, but you've had a different experience depending on which metrics you use. But so anyway, getting back to it, I mean, I don't think, we've seen this in the past. And then I get back to the academic stuff we talked about at the beginning, the risk-based explanation and the behavioral-based explanation. So is there anything going on that would tell me that either of those don't hold anymore? Are value stocks no longer riskier than the market? I mean, I don't see any evidence from what's going on right now that that's true. Are people no longer overestimating the problems of value? I mean, I don't think that's true either. Although I do think that the narrative thing we talked about is something all of us have to keep in mind. And, we had Steve Romick on our other podcast, and we were talking about this idea, is narrative more important than fundamentals now? And, he said, I expect fundamentals to win out in the end. But one of the things I've done is I've lengthened my time frame because of what's going on, like around narrative being more important in the market. And I think that's probably true. I think, value investing is probably not dead, but all of us that are value investors need to think probably over even longer time frames than we did before, which goes back to what I said before, which is why I think your average investor should probably not be playing in the value world. And if they are, they should be doing it, probably with higher quality companies, or they should be doing it with more diversified portfolios that hold lots of stocks. Like focused value investing can be really, really rewarding. I think it's going to work over time, but it's really, really tough.
Couldn't agree more. And I think the only thing I'll add to that is on the financial planning side. I think when we think of the trade-offs between human capital and investment capital, and we think about those things through value, financial analysis, all this stuff, marrying the risk side with the psychological side, it's a critical part of just giving context to the world around us. Like we want to be able to think through things the way that you've been explaining it through this whole episode, where we want to be able to explain what's going on when I'm trading my blood, sweat, tears, man hours, whatever, in exchange for whatever I'm doing. And that's either the company I'm employed by or the company I'm creating and running. Where am I in the growth curve? What's the story about where I'm going? What's my time horizon for where I hope this story is going to be right or wrong? If I'm on a melting ice cube, I better understand the liquidation strategy. If I'm on a glacier, I better understand what keeps the glacier slowly expanding versus starting to rapidly shrink under what macro conditions. And if it's something where I'm defining a whole new area, category, whatever, where I'm going to grow a new glacier, either in a company I'm starting or one that I'm working for, I want to have an idea of when that rate of change is going to shift and if I'm cool with that or not.
I'm just curious before we wrap up here, is this something you care about a lot? Like, I mean, I live in this world where I'm talking to all these other value investors and we're all like, is value investing dead? And like, sometimes I think about like, if I got outside of that world, like and you're running financial planning practice, you've got clients, like do your clients, is this something you talk about? Do you care about it? Like, I'm just interested to think like outside of my bubble, like how people view this whole thing.
I love this stuff because this is where like, this was a huge gateway to just trying to make sense of investing for me. One of the first things that ever like made intuitive sense to me where I was like, tell me more about that. I get that was reading Greenblatt, was reading the little book that beats the markets. And then diving into all of his stuff, reading the class lectures and reading the terribly titled You Can Be a Stock Market Genius book.
Which is a great book, by the way, despite the title.
One of my all-time favorite investing books because he kind of lays out and breaks down all this stuff. And I was like, oh, this is what investing is. But then more importantly, and to your question, like, do I care about this stuff? I care about the philosophy and the logic of this stuff because it all applies to real life. Back to the point I made earlier, it applies to our careers. It applies to the companies we choose to work for and start. And if we understand this logic and how the narratives swirl around us that are not in our control, we can start to have an understanding for this. For me, as a practitioner and somebody trying to understand this stuff, there's a huge difference in the feeling of getting somebody started out on that growth curve with a new and exciting idea and that boom bust break even and all the little funny little tricks and stuff that I try to share on these episodes. I love getting somebody who's eager to go out and start the formation of that next glacier. But I also love the human connection and the empathy and the care that needs to go into the process of having like I had a second generation business owner and just being like, it's time to shut this down. How do we do this? Because you're basically killing a part of yourself and your family legacy. And how do we do this and make you still feel okay? Because we can talk about this in the cold hard math of systematic trading strategies, but the language of value is so useful in connecting to the true raw human side of trading our human capital for investment capital.
And this is why I think, even investors who are not value investors, or even investors who don't, spend all their time on this, we talked about so many concepts here that are really important for investing. So the process of analyzing whether value investing is dead, I think teaches people a lot of important concepts. It teaches people why certain investing strategies work. We talked about economic regimes. We talked about the Fed. We talked about analyzing companies. So I think it's a useful discussion, even for people who aren't going to ever follow value strategies, just to understand. And like you said, it comes back to real businesses and real people. And so all of it, I think it's a useful discussion to have, even if, you don't need to have a conclusion. We don't have to draw the conclusion here, is value dead, or we don't even have to care about the conclusion. It's the discussion is a valuable thing nonetheless.
The gods are all dead. Long live the gods. This is the stuff. This is why we're talking about it on a financial planning podcast. This is why we're talking about this on an investment podcast and sharing it on the channels, because this logic, this stuff, and understanding it philosophically as much as if you're going to apply it quantitatively and build your wares that way. It matters that we know this stuff. It matters that we talk about this stuff. And that's why I was so excited to have this conversation with you today.
Well, great. I guess we can wrap up on that since we've gone 50 minutes, and YouTube tells me people only listen to about 12. So hopefully we got the good stuff in the beginning.
The melting ice cube.
Oh, yeah, for our YouTube channel. Anyway, thank everybody for joining us, and we'll see you next week.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbonneau, and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.